no shortage of data to tell us about how the economies of the world are faring during the coronavirus lockdowns. What will it take, though, in upcoming economic data to shock the market lower? I mean, we're back to almost, pre-COVID levels. It's almost crazy. John Reilly from Implemented Portfolios joins us now to tell us what he's seeing. John, good to have you with us. We've got another slew of data sort of coming out this week, both domestically and internationally. What sort of numbers and how quickly do you think some of this data could actually have another big impact on markets? Or do you think investors are just prepared to keep looking through?
Good afternoon, and thanks for the opportunity to talk with you again. I'm much more in the camp of the latter there. I think expectations were really set going back about a month or so ago, and we looked to the Chinese economy. The early signs there were that we had in the initial data was the survey-based data, the PMIs, those sorts of things, which we will get an update on in very soon. But then we started to see the first real economic data coming out around the middle of March. And the results in terms of retail sales, industrial production, real estate investment were actually much, much worse than the worst case scenarios that analysts had expected. And that, I think, was the shock that initially saw us. And I don't think it's any surprise that data was released on the 16th of March. It was about a week later in most markets, most equity markets. We've seen a bottom there. Since then, we've obviously seen a very sharp rebound back above the 50 level on Chinese PMI to get back into expansion level. And I think more importantly, when we saw Chinese GDP go into contraction from a plus 6.0% annualized rate of growth to a minus 6.8 Q1 number, and the market kind of shrugged its shoulders. So I think we're likely to see awful economic data coming. I don't think anyone is deluding themselves at this point that things are good at this time. But yeah, the way you framed the question is really important. How much of that is already been discounted by market participants? And to my mind, I think it's, there's a balance of risks in these things always. And it might actually be the case that the economic data is not quite as bad. The US is still an area that worries me. And we've seen, obviously, literally off the charts type numbers there. There was an amazing data point that Deutsche Bank highlighted in the US just recently, which said their economy had created 22 million jobs post the 2009 recession. And there's 22 million initial jobless claims just in the last 4 weeks. So that really gives some scale there. What we've also seen, though, is upgrades to not just Q2 and beyond, but probably more importantly into 2021 data. And in a lot of instances, it does look like we might see the V-shaped recovery. Certainly, some local researchers are predicting strong rebounds in the China numbers. The IMF itself is saying 9.2% for 2021 GDP. So I think that's the important context. From an Australian point of view, we dodged a bullet a little bit with the latest jobs numbers. We know, digging into the detail on that the data collection was focused around the first half of March. So I do expect there's going to be quite a significant hit in the Australian labour market. One important point when that data does come out, though, is that recipients of JobKeeper payments won't be included in the unemployment data, even if they haven't worked for at least 1 hour there. So whilst we've again seen early data leading indicators like surveys, consumer confidence, business confidence collapse, we need to, I think, have already discounted a lot of that bad news. Perhaps the next big test for the Australian market will be when we get updates from the major banks on what their dividend cuts are going to look like. We know APRA has already said quite explicitly they're expecting to see material reductions in those dividends. And a lot of the analyst community does already seem to be factoring in around 50% cuts for first half 20 dividends out of the banks.
Okay. So, John, from what you're saying, because here on Ausbiz, we have a lot of analysts saying, putting out stocks that they'd be buying on the next pullback, that will have another pullback. There will be shocks to the market. But when everyone's talking about 12% unemployment here in Australia, 17% in the United States, contraction of 6 or 7% in the economy, sort of we're almost becoming accustomed to bad figures going forward, as you say. So will there be a shock to spark a pullback? What sort of shock would it take?
I'm struggling to think what that might be.
Right.
And I think it's also important to note that there's a huge dispersion of those estimates. Jobs numbers I'm seeing anywhere from 8s, I think Treasury's at 10, other private analysts are forecasting 12s, 13s, bigger
Yeah.
numbers again. One major caveat to this whole discussion is if we obviously start to see a pickup in coronavirus cases again. So absent that, I think a lot of the bad news is priced in. And if you're waiting for a significant pullback, obviously it's going to be a bumpy ride. And it sounds prudent to say that we'll go back and test those lows again, but the central bank and government response, not just in Australia but around the world, is as we all know, unprecedented.
Right.
If they are successful in pulling off that bridging the gap policy response that the central bank here and the government have been talking about, then I think the recovery can take foot. People get back to work. I suspect there's plenty of people that want to get back to the office, that certainly want to go and eat in restaurants again. Perhaps we're not going overseas for travel until next year, but I'm struggling to see that the numbers are going to be bad enough for us to plumb those March 23 lows.
Okay, so Europe's gone through their peak. America, or New York at least, looks as though it's past the peak. What you're saying is everything's been factored in for the next 12 to 18 months, except if America and Europe do what Singapore is doing now and have another wave before we get the silver bullet of a vaccine.
Yes, yeah, I think that's a fair comment, absolutely.
That is a pretty scary thought, though, isn't it?
And look, there's we need to be humble here as market participants. We're not epidemiologists, as much as we try and educate ourselves on these sorts of issues. So there's plenty of those people that saying some form of these viruses is likely to be part of our landscape for the foreseeable future. So you would hope we've learnt some lessons. I think we're stood in fairly good stead at the moment because of some of the lessons that we learnt post the 08-09 crisis in terms of the policy response. Go big, go early. The best problem you can have is to put too much stimulus in the system and then have to pull it back. So if we can learn some of those lessons about being better prepared to deal with pandemics, which may be part of our ongoing work life and social life, then that's going to be some important learnings as well.
John, do you think that pricing in actually takes into account the potential length of time to recover from this? Looking at some of the numbers that the Grattan Institute's been talking about, looking at the letter from the economists that's all been signed and sent recently. Some of those timings seem to be, it could be quite some time until, we get back to whatever is considered normal.
Yeah, I'm reluctant in the midst of a crisis to draw conclusions about, the world's never going to be the same again. I suspect when we do have confirmation that it is safe to start reopening parts of the economy, that there's going to be, significant pent-up demand. We've got extraordinarily low interest rates, and they're likely to stay there for at least the medium term, if not the longer term. We've got extraordinary fiscal policy support provided there as well. So I think the recovery might surprise us in terms of how quickly it might come.
Yeah, and particularly if China can maintain that recovery in its economy as well, isn't it? If they start as our biggest customer, they could be the cushion for us again, like they were in the GFC.
Yes, absolutely. I couldn't agree more. And I would just add Korea to that list as well. I think if anyone's shown that the best way of dealing with this, they've just held an election with no problems at all. Apple's opened their first store in Seoul, the first one outside of China. So life is getting back to normal in China and Korea. And so, I think, the risk to the Chinese outlook is reduced demand from their global clients and customer base. But they're showing that the recovery can just businesses that we can decide to reopen them again. And so I think, I've read a lot of analysis that talks about we've seen a 50% retracement from the bear market lows, but that's going to be tested again. I just think this crisis in particular, more so than ones that have been analysed historically, is going to have its own nature and its own characteristics, and those past patterns may not be particularly helpful in trying to determine what the next weeks, months, quarters look like.
Okay, all right.
Thank you.
Pleasure.